There's a big difference in your pre-tax money and your post-tax money when it comes to investing, especially in a jurisdiction like the UK when the tax rate is really, really high. We are talking about people who are earning between 50K to 125K. Your 40% of your salary goes to tax. So how can I effectively get a 40% bonus and then invest using that pre-tax money? So you want to do that as much as possible. And SIP is one instrument where you can do that. So let me explain how it works. Let me use an example, because the calculation for SIP can be so complex that there's not even an online calculator that tells you, how much money are you getting from SIP. Let's say you are in the 40% tax bracket and you manage to save £6,000 every single year between the 6th of April to the 5th of April next year, every single year. And in this case, let's assume your emergency funds are being taken care of and you don't need this £6,000 until you are 55, retirement age. So what you could do, you could open a SIP account. You can use the link below, wink, wink, and deposit the £6,000 into a SIP account. Again, this kind of just works like ISA in that you can just put the money in and you don't need to buy any investment instrument. Just leave it as cash, just so that you can set the system up. Immediately, your SIP provider will add an additional 20% on top of the £6,000 that you have contributed. And this is the calculation. So you get back part of the tax that you have paid on this £6,000. Because think about it this way. For you to take home £6,000, right? This is your post-tax money. Your gross salary equivalent would be £10,000. So if I want to invest, of course, I'm going to invest using that £10,000 as much as possible, because that's more money to invest. So when you open a SIP account, this £6,000 is being topped out to £7,500, right? The SIP provider gives you that £1,500. You still have an additional £2,500 that is not claimed. So what happens is, at the end of the year, when you file a self-assessment, this is your tax return in the UK, the HMRC will reduce your tax expense by £2,500. This is how you effectively neutralize the effect of tax on your £6,000 of take-home pay. And SIP is an amazing instrument to do that. Of course, the catch is you can only access SIP or take the money out when you're 55. Otherwise, you face a huge penalty. And also, when you do take out your money from SIP when you're 55 and above, income tax would apply at that point, whatever the prevailing income tax rate is at that point.